So we get to B. We get to B. So on B, the examiner tells us that explain 3 ways through which individual could engage in what you call tax avoidance. When you talk about tax avoidance, this is basically a legal means through which people minimize their tax burden. And when it is noticed that one is avoiding the taxes, no penalties and interest can be instituted. The commissioner can basically seal the loophole, but we all understand that no penalties and interest can be instituted to the taxpayer. So the taxpayer is able to study the tax system and identify loopholes in the tax system and take advantage. Or we can say that the arrangement of the taxpayers in such a way that they are able to legally minimize the tax burden. What are these ways that an individual who is a taxpayer could basically engage in what we call tax avoidance? So one of the ways that a taxpayer could engage in tax avoidance is buying an asset instead of leasing. When you buy an asset instead of leasing, you can actually claim for what you call investment allowance. So we cannot buying an asset instead. We say instead of leasing. Buying an asset instead of leasing in order to claim for investment, allowances. Buying an asset instead of leasing in order to claim for what you call investment allowance. So that is one of the options. So claiming for allowable deduction. Number 2, claiming for allowable deduction. When you talk about allowable deduction, these are actually deductions that are made to the taxable income before they're subjected to tax. What it does to the taxable income is you're able to reduce the taxable income, and therefore that leads to a lower tax being paid. So say claiming what you call allowable deductions, e.g. we have mortgage interest, e.g. mortgage interest, contribution to pension, and we also contribution to OSP, OSP is Home Ownership Saving Plan. So contribution to OSP, which is Home Ownership Saving Plan. But just to stress and just to emphasize, when you talk about, for example, mortgage, those who take mortgage to build a residential, we say that you are basically going to check the actual contribution that has been contributed with the set limit. That is, as at 2024 December, that limit is 300. But based on 2025, we know that there are emerging issues, and 2025 now for the mortgage, that is actual. You'll compare actual contribution with the set limit that we know is 360. Same to the pension, contribution to pension. As at December 2024, the pension is, the set limit is 240, and you compare it with the 30% of the gross employment income and the actual contribution. But as of 2025, the rates for the 2025 pension is also increased. The set limit is increased to 30 per month and 360 per annum. So that is on claiming what you call allowable deduction. But you can also talk about one of the areas that a taxpayer can reduce the tax is investing in areas where incomes are exempted from tax. Investing in areas where income is what call exempted from tax. Investing in areas where incomes are exempted from tax. These are the tax havens. When you look at the tax havens, those areas incomes are basically are basically exempted from tax. We can have the fourth one, where we talk about investing in income, investing in income, where we talk about investing income where withholding tax, we call it withholding tax. Withholding tax is final tax. Investing in income, so withholding tax is a final tax. What are these areas? We talk about qualifying dividends and interest. When you receive dividends from a limited company, those dividends, the 5% withholding tax is basically final. Interest from SACCO, the 15% interest is basically final, i.e. qualifying. We have qualifying dividends and interest. So when you invest in basically in qualifying dividends and interest, we know that the 15% withholding tax is basically final, and qualifying dividends, the 5% withholding tax is final. We can talk about engaging in what you call export instead of what you call local sales. Since we know that since exports are what you call as zero rated. Instead, since exports are zero rated, meaning that we claim VAT at the rate of 0%. If you engage in local sale and precisely you're making a turnover of 5 million, basically you're going to pay VAT. But now if you engage in export instead of local sales, we know that the export are essentially zero rated. Financing, we talk about financing. We can talk about financing through debt instead of shares. Financing through debt instead of shares. When you finance through debt, we say that interest that accrue basically from a debt is what you call allowable deduction. Interest that accrue from a debt is what you call allowable deduction. And the cost of shares, that we know that the cost of shares is what you call dividends. Dividends is not an allowable deduction. So if a company basically finance through debt, the interest that we know basically accrue from a debt is what you call allowable deduction. But if you finance through shares, the cost of shares is dividends, and that is not allowable deduction.